Introduction. Why start with history? When diving into the world of investment banking, history isn't just a backdrop, it's the foundation. In most industries, history may be nothing more than a paragraph in a textbook, a minor footnote. But here, in the high-stakes, high-trust realm of investment banking, history is one of the most valuable currencies. Reputation, legacy, and tradition aren't just soft values. They shape how deals are made, how clients choose partners, and how financial empires are built. Why is this so important? Because investment banking thrives on trust. A bank that has stood for over 2 centuries commands more than prestige. It holds the weight of experience, connections, and resilience. These institutions have weathered wars, recessions, booms, and busts, and their names carry the confidence of generations of investors. When a government or corporation selects a bank to handle its IPO or bond issue, it doesn't just look at performance metrics, it looks at legacy. That's why understanding the historical roots of investment banks isn't just academic, it's essential. Before we analyze the services they offer today, we must explore how and why they emerged, and what shaped their evolution. To understand the future of finance, we must first understand its past. The origins, how investment banking emerged in America. To understand how investment banking took root in America, we must travel back to the 19th century, a time when the United States was undergoing a dramatic transformation. The Industrial Revolution had gripped the country, igniting a wave of economic expansion. Railroads carved paths across vast landscapes, mining operations dug deep into the earth, and heavy industry roared to life in every major city. The economy was growing at a pace that traditional financial institutions simply could not keep up with. Commercial banks, bound by strict regulations and limited lending capacities, were not designed to finance large-scale industrial projects. They focused primarily on accepting deposits and making short-term loans. But the economy needed more. It needed long-term capital, bold financial vision, and institutions willing to take on risk. This demand created space for a new kind of player, the investment banker. These early investment bankers, often referred to as financial middlemen, stepped in to bridge the widening gap between those who needed capital, industrialists, railroad barons, mining magnates, and those who had it, wealthy individuals and emerging investor classes. Their core function was what we now call security underwriting. They would purchase large quantities of bonds or shares from issuers and resell them to investors, typically at a profit. But underwriting wasn't just about flipping securities. It was about judgment, timing, and trust. Investment bankers didn't just provide funding, they offered credibility. Their involvement in a deal signaled to investors that the offering had passed through a filter of experience and scrutiny. In doing so, they became more than intermediaries. They became architects of capital markets. Thus, investment banking in America wasn't born from regulation or government policy. It was born out of necessity, a natural evolution triggered by industrial ambition and financial innovation. Who were they? The powerful middlemen. In the early days of investment banking, power did not reside solely in the hands of governments or industrial giants. It rested quite strategically in the hands of a select group of individuals who mastered the art of connection, trust, and financial engineering. These were the middlemen, intermediaries who didn't just move money, but shaped the very flow of capital across nations. Governments, especially in the 19th century, found themselves in urgent need of funding for infrastructure, defense, and industrial development. But they lacked 2 crucial things: technical expertise in the financial markets, and the credibility to sell bonds directly to the public. Individual investors were skeptical. They feared defaults, manipulative pricing, and being left without representation in high-stakes negotiations. That's where the middlemen stepped in. These early investment bankers had the know-how, the relationships, and perhaps most importantly, the reputation to get deals done. They didn't just help governments issue bonds, they became the face of trust for skeptical investors. They negotiated terms, ensured proper pricing, and committed to purchasing a portion of the bonds themselves, placing their own capital on the line. But before they agreed to underwrite any bond issuance, they followed a meticulous process. They reached out in advance to their network of wealthy investors to gauge interest and secure commitments. They ensured there was a clear exit strategy before taking on risk. These were not gamblers, they were strategic financiers. And when defaults happened, as they did in 1842, when 8 U.S. states failed to repay their debts due to a crash in cotton prices, it was these very middlemen who fought to protect their investors. Their power wasn't in coercion, but in access. If you crossed them, you were cut off from future capital. They weren't just intermediaries, they were gatekeepers of trust, and the earliest symbols of what would become the investment banking elite. Reputation is the strongest currency. In the world of investment banking, money moves fast, but reputation moves everything. During the formative years of global finance, investors weren't just swayed by numbers or yields, they were influenced by the names behind the deals. In this high-stakes environment, the identity of the underwriter often mattered more than the instrument itself. The question wasn't simply, is this bond profitable? It was, who is standing behind it? Reputation became a kind of financial seal of approval. When a trusted banker or firm underwrote a bond or stock issuance, investors viewed it as a mark of legitimacy. It was an implicit guarantee that the offering had been thoroughly vetted and that someone with skin in the game believed in its success. The stronger the name, the faster the offering would be absorbed by the market. But with reputation came responsibility. Investment banks had to uphold their credibility across every transaction. A single failed deal, one misstep in judgment, could unravel years, even decades, of carefully built trust. In this world, you didn't just sell securities, you sold your name. And that's why in investment banking, reputation wasn't just a currency. It was the most valuable asset of all. The Rothschilds, living legends of global finance. Few names in financial history command as much awe and mystique as the Rothschild family. They weren't just bankers, they were architects of global finance, blending political intelligence, international reach, and unmatched foresight to dominate European markets for over a century. One of their most legendary feats took place during the Battle of Waterloo in 1815. Through their private network of couriers and informants, the Rothschilds received word of Napoleon's defeat a full day before the British government. Rather than rush to celebrate or alert the authorities, Nathan Rothschild used the information strategically. He began purchasing British government bonds while others panicked. When news of victory finally reached the public, the market soared, and Rothschild walked away with a 40% profit. It wasn't luck. It was logistics, speed, and shrewdness. Their influence extended beyond money. In fact, their wealth became almost mythological. Kaiser Wilhelm of Germany once marveled at one of the family's estates, claiming, "Kings could not afford this. It could only belong to a Rothschild." That statement wasn't hyperbole. It was recognition of a dynasty that stood above royalty, operating silently behind the curtains of power. Even their eccentricities were legendary. Lord Walter Rothschild, a passionate zoologist, once drove a carriage drawn not by horses, but 6 zebras, straight to the gates of Buckingham Palace. It wasn't just a stunt, it was a message. The Rothschilds lived by their own rules, with wealth so immense that the line between audacity and brilliance often blurred. In many ways, the Rothschilds were the blueprint of what investment banking could become: powerful, perceptive, and unshakably influential. The big question: where are commercial banks in all this? By now, a reasonable question begins to form. Where do traditional commercial banks fit into this picture? The banks where most people deposit their paychecks, take out loans, or open savings accounts? Aren't they also in the business of finance? Yes, but their role is fundamentally different. Commercial banks serve the general public. Their core function is to collect deposits and issue loans. They operate on a simple but powerful model. Gather funds from depositors, lend those funds to borrowers, and earn money from the interest rate spread, the difference between what they pay depositors and what they charge borrowers. These banks are the financial backbone of everyday life: mortgages, car loans, business credit lines. Their focus is on liquidity, safety, and volume. By contrast, investment banks function in an entirely different financial universe. Their clients are not everyday consumers, but corporations, governments, and institutional investors. Their products are not savings accounts or credit cards, but IPO strategies, bond issuances, mergers, and asset portfolios worth billions. Think of it this way. A commercial bank is like a well-run supermarket, managing cash flow and meeting daily needs. An investment bank, on the other hand, is a global consulting firm mixed with a high-stakes trading house, part strategist, part dealmaker, part risk-taker. The confusion arises because both are called banks, but their missions, methods, and markets are drastically different. And as we'll soon see, attempts to combine these two models into a single institution have created some of the biggest debates and disasters in modern financial history. Universal banks, dream model or dangerous merger? With such stark differences between commercial and investment banks, a new idea began to take shape in the financial world. Why not combine the two? Why not create a single financial powerhouse capable of offering everything, from checking accounts to billion-dollar bond offerings, under one roof? This idea gave rise to the concept of the universal bank. In theory, the benefits were compelling. A universal bank could become a one-stop shop for clients, offering deposit services, loans, investment products, underwriting, and financial advisory all in one place. The bank could deepen customer relationships, sell multiple services to the same client, and use its commercial arm to gain valuable insights about businesses that could later become investment banking clients. There were also economies of scale. A universal bank could leverage synergies between departments, improve efficiency, and reduce operating costs. For corporations, working with a universal bank meant fewer partners, more integrated services, and a tighter financial strategy. But alongside the dream came growing concerns, and with good reason. Universal banks have access to vast internal information. If a company is a borrower through the commercial division and later seeks to go public, the bank already knows its financial vulnerabilities. That knowledge, if misused, could compromise market fairness. Worse, universal banks might be tempted to push risky investments onto public markets just to reduce exposure on their own books, selling risk to avoid taking the hit themselves. This creates a conflict of interest at the heart of their operations, acting both as the advisor and the seller, as the lender and the underwriter. The very structure of the universal bank blurs ethical lines, prompting regulators and economists to question, can one institution truly serve two masters, safety and speculation, without tipping the balance? The Glass-Steagall Act, the wall that was built and then broken. In the aftermath of the Great Depression, when trust in financial institutions had crumbled and public outrage boiled over, U.S. lawmakers took a bold step to restore order. The result was the Glass-Steagall Act of 1933, a legislative firewall built to separate the high-risk world of investment banking from the essential functions of commercial banking. The message was clear. Banks that accept deposits and safeguard public savings should not be allowed to speculate in the securities market. Under the Act, commercial banks were prohibited from engaging in investment banking activities, including trading and underwriting. Conversely, investment banks were banned from taking deposits or issuing consumer loans. The goal was to eliminate the conflicts of interest that had fueled reckless behavior and helped trigger the market crash of 1929. For decades, this barrier protected the financial ecosystem, forcing banks to choose a clear identity: either serve the public with stability or serve the markets with risk and innovation, but not both. But as the 20th century progressed, pressure mounted. Banks wanted more freedom. Markets demanded more flexibility. In 1999, after 66 years, the Glass-Steagall Act was repealed, ushering in a new era of financial conglomerates. Universal banks like JP Chase, Citigroup, and Bank of America quickly rose to power, offering commercial and investment services side by side. The move was hailed as modernization until the 2008 global financial crisis hit. Suddenly, the absence of Glass-Steagall safeguards looked less like progress and more like a fatal blind spot. The same institutions that were too big to fail had become too entangled to control. The wall was broken, and the consequences reshaped financial history. Core services of investment banks. While modern investment banks offer a wide range of services, two pillars remain at the very heart of their operations: underwriting and advisory. These aren't just legacy functions, they are the core competencies that define the value proposition of investment banks to this day. Underwriting involves helping companies and governments raise capital by issuing stocks or bonds. Investment banks assess the financial health of the issuer, price the securities, purchase a portion of them upfront, and then sell them to investors. It's a high-risk, high-reward process that requires deep market insight and investor trust. The bank puts its own reputation and often its own capital on the line. Advisory, particularly in the realm of mergers and acquisitions, M&A, is the other cornerstone. Here, investment banks serve as strategic partners, guiding corporations through complex transactions, from valuation to deal structuring to negotiation. These deals often reshape industries, and the right advisor can mean the difference between a successful merger and a disastrous takeover. Beyond these two core functions, investment banks have expanded into trading, research, and asset management, offering institutional and high-net-worth clients a full suite of financial tools. But regardless of how broad their services become, it's underwriting and advisory that continue to define the soul of investment banking, where trust is earned and where enduring relationships are built. Ethics and the Chinese walls. As investment banks grew larger and more complex, so did the ethical challenges they faced. The core issue stems from a simple reality. When a single firm handles multiple financial services, information becomes both a weapon and a liability. And when that information flows too freely, the consequences can be catastrophic. Imagine an investment bank that is underwriting a company's stock while simultaneously providing research reports to the public and trading that same stock for its clients, or even its own account. Can you truly trust that research to be impartial? Or that client trades won't be disadvantaged by the firm's own trading desk? These are not hypothetical scenarios. They have happened. The result is what regulators call conflicts of interest, where one division's goals compromise the integrity of another. To combat this, investment banks instituted what are known as Chinese walls, metaphorical barriers between departments. These walls are meant to prevent the unauthorized sharing of sensitive, non-public information between divisions that could use it unethically. For example, research analysts are walled off from investment bankers to avoid biased reports driven by deal incentives. While not perfect, these internal firewalls are essential to maintaining transparency, client trust, and legal compliance in an industry built on access and influence. In a business where even a whisper of insider advantage can damage reputations and spark investigations, the existence and enforcement of Chinese walls is more than formality. It's a matter of survival. The Weinberg-Ford story. How one advisor transformed an industry. In the world of investment banking, numbers can impress, but relationships make history. Few stories illustrate this better than the legendary partnership between Sidney Weinberg, longtime leader of Goldman Sachs, and Henry Ford Sue, heir to the Ford Motor Company empire. When Henry Ford Sue took over the family business in the 1940s, he inherited more than a world-famous brand. He inherited a company in disarray. Ford was the largest privately owned company in the U.S., but it was struggling with internal inefficiencies, financial mismanagement, and a rapidly evolving auto market. What Ford needed wasn't just capital. He needed a trusted advisor, someone who could bring in not only expertise, but integrity and strategic vision. That man was Sidney Weinberg. Weinberg helped Ford recruit top-tier executives, reorganize the company's structure, and restore credibility in the eyes of investors. But his most defining contribution came in 1956, when Ford made the historic decision to go public. The initial public offering, IPO, of Ford Motor Company was, at the time, the largest in U.S. history, and Goldman Sachs, led by Weinberg, was at the helm. The deal was a resounding success, cementing Ford's position in the modern corporate landscape and catapulting Goldman Sachs to the top tier of Wall Street's elite. But beyond the numbers, it was a testament to the power of trust, loyalty, and long-term thinking in investment banking. Sidney Weinberg wasn't just a banker. He was a counselor, a confidant, and a quiet architect behind one of the greatest corporate turnarounds of the 20th century. His story reminds us, at the highest level, investment banking is as much about people as it is about money. Conclusion, and lead into what's next. From its humble origins in 19th century America to the boardrooms of today's global giants, investment banking has proven to be far more than a financial service. It's a force that shapes industries, economies, and history itself. The stories of powerful families, landmark deals, and financial revolutions all point to one truth. In this world, credibility is currency, and strategy is power. But we've only scratched the surface. In the next section, we'll explore the core activities that drive modern investment banks, from IPOs to M&A advisory, asset management to proprietary trading, and uncover how these institutions continue to influence the world behind the scenes.